And again, everyone, welcome to my YouTube channel, which is Explore Yourself, Banking, and General Knowledge, etc. Today, I will discuss about group discussion topics related to the internal promotion examination for eligible bank employees. Welcome to part 22 of my Path to the Corner Office 2025 to 2026 series, where I break down real bank promotion exam questions and give you clear, practical sample answers about group discussions to help you climb the career ladder faster. Group discussion topic. Performance management system in banks, fair or flawed? Introduction. Performance management system (PMS) in banks refers to a structured framework used to assess, monitor, and improve employee performance against predefined objectives. In the highly competitive and regulated banking environment, PMS plays a critical role in linking individual performance with organizational goals such as profitability, asset quality, customer satisfaction, and compliance. However, the system often triggers intense debate. While some view it as a fair, objective, and motivating tool, others criticize it as biased, target-driven, and misaligned with ground reality. This discussion attempts to evaluate whether PMS in banks is truly fair or inherently flawed. Objectives of performance management system in banks. The key objectives of PMS in banking institutions include aligning individual goals with organizational strategy, improving productivity and accountability, identifying training and development needs, supporting promotion, incentive, and career progression decisions, encouraging a performance-oriented culture. Ideally, PMS should create a transparent, measurable, and motivating ecosystem that rewards merit while supporting underperformers. Key components of PMS in banks. Most banks follow a structured PMS comprising key result areas such as business growth, CASA recovery, NPA control, and cross-selling. Behavioral competencies like leadership, teamwork, customer orientation, and integrity. Mid-year and annual reviews. Self-appraisal and reporting authority assessment. Final scores linked to promotion, incentives, and postings. Despite uniform frameworks, implementation differs significantly across banks and branches. Documents supporting PMS as a fair system. Objectives and measurable evaluation. Modern PMS relies on quantifiable indicators such as deposit growth, credit expansion, recovery percentages, and digital transactions. This reduces subjectivity and ensures performance can be compared across peers. Accountability and ownership. PMS clearly defines roles and expectations, making employees accountable for their outcomes. This promotes ownership of targets and discourages complacency. Merit-based promotion. In promotion exams, PMS scores often carry weightage, ensuring consistent performers are rewarded over purely seniority-based advancement. Alignment with business goals. Banks operate in a competitive market. PMS ensures employees contribute directly to profitability, risk management, and customer acquisition. Encourages skill upgradation. With PMS highlighting performance gaps, employees are encouraged to upgrade skills in credit appraisal, risk management, digital banking, and compliance. Documents highlighting PMS as a flawed system. Excessive target orientation. A major criticism is overemphasis on business targets, often at the cost of quality. This can lead to compromised credit appraisal, aggressive selling and mis-selling, stress-induced unethical practices. Ignoring ground realities. Uniform targets across diverse geographies fail to account for rural versus urban market potential, economic slowdown, or local disturbances, limited staff strength in certain branches. This makes PMS unfair for employees in difficult locations. Subjectivity and bias. Despite structured formats, final ratings often depend on the reporting authority, leading to favoritism, halo effect, or personal bias. Inadequate weightage to compliance and risk. Risk prevention, audit compliance, and long-term asset quality are less visible and poorly rewarded compared to short-term business growth. Psychological stress and burnout. Continuous monitoring, frequent reviews, and fear of low ratings cause anxiety, reduced morale, and work-life imbalance, especially among middle management. Impact of PMS on organizational culture. Positive impact. Promotes performance-driven mindset, encourages competition and innovation, helps identify leadership talent. Negative impact. Weakens teamwork due to individual targets, encourages short-termism, creates fear-driven rather than value-driven culture. Thus, PMS significantly shapes banking culture for better or worse. PMS in public sector banks versus private banks. Public sector banks, PMS implementation is often rigid, promotion is still partly seniority based, limited monetary incentives, higher job security reduces performance pressure. Private sector banks, highly target driven PMS, strong incentive linkage, faster career growth but high stress, lower tolerance for underperformances. Both models have strengths and weaknesses, suggesting a need for a balanced approach. Recent improvements in PMS. Banks have initiated reforms such as balanced scorecard approach, 360-degree feedback for senior roles, greater emphasis on digital adoption and customer service, training and linked performance improvement plans. These indicate a shift from purely target-based evaluation to holistic performance measurement. Suggested reforms for a fair PMS. To make PMS more equitable and effective, the following reforms are suggested. Differentiated targets based on branch potential, higher weightage for asset quality, compliance, and risk control, transparent rating rationale and appeal mechanism, reduced frequency of reviews to lower stress, integration of team-based performance metrics, greater focus on ethical behavior and long-term sustainability. Way forward, a fair PMS should balance performance, prudence, and people. Banks must move from a one-size-fits-all approach to a flexible, data-driven, and human system. Technology, analytics, and AI can help create more objective and real-time performance insights, while leadership empathy can ensure fairness. Conclusion. Performance management system in banks is neither entirely fair nor completely flawed. Its effectiveness depends on design, implementation, and intent. When used as a developmental tool, PMS can motivate employees and strengthen banks. However, when reduced to a mere target-chasing exercise, it becomes flawed, stressful, and counterproductive. Therefore, PMS must evolve into a balanced system that rewards performance without compromising ethics, asset quality, and employee well-being. Thank you very much for your patience. Request for like, subscribe, and share.